Welcome to Barchart's weekly series of webinars to help you, the investor trader, understand a variety of trading concepts, but more importantly, the pages and tools that Barchart provides you to support you in making a more informed investment decision. Today's subject, dogs of the Dow. This conservative buy and hold strategy can be part of a larger diversified trade plan that looks for value stocks with high dividends yields and the potential for price appreciation based on upon current and developing economic trends. Hello, my name is John Rowland, and I'm going to walk you through the dogs of the Dow strategy. I'm going to show you how to identify these dogs, these stocks, and to look at some of the pages and tools that will allow us to make these comparative analysis, help us track. Let's wake up my computer, see there, track and watch their performance. Plus, I want you guys to gain a greater understanding of what is a value stock and the idea around market rotation as a market, as stocks mature and we see monies flow from one sector to another. With me today is our moderator and my partner, Jean Baker. Hello, Jean.
Hi, John. Hello, everybody out there.
Happy New Year to you and our subscribers.
Yes, Happy New Year. Happy 2021. Glad it's here.
Yeah, put 2020 behind us, right?
That's right.
I'll tell you what, I'm really excited for us this year because I think we're going to discover some really interesting subject matters this year, and as well as a lot of new features that Barchart is going to roll out, right, Jean?
That's right.
Cool. So I'm looking forward to that. All right, just this is our disclaimer again. You know, we do this for all of our webinars that the decision to buy, sell, or hold or trade any security, commodity, or other investment involves risk and best made on the advice of a qualified financial planner. And that before undertaking any trading program, you should consult a qualified professional planner and consider if such trading is suitable for you in light of your financial conditions and your ability to bear financial risk, okay? But I want to give full disclosure to today as well, because we are going to look at some very specific stocks, 10 to 12 stocks today that are part of the dogs. And I want to disclose that I do own one of these stocks, Coca-Cola, which is kind of funny today because of all the dogs, Coca-Cola is the only one that is down today. So it shows you what I know about investing. And I do own a mutual fund who invests in blue chip Dow stocks, though I'm not aware of the portfolio makeup. There is a high probability that one or several of these Dow dogs could be part of that portfolio manager's position. Just to give you a kind of point of reference, though, that this mutual fund has been part of my retirement account portfolio for decades. So, you know, I've been in this thing for a long period of time. All right. So, I apologize, my animation is not working here, but let's look at the history of the Dow. First of all, Michael Higgins popularized this in, I believe it was his book, Beating Wall Street, back in 1991. And what it does is at the beginning of the year, it looks at the 10 highest yielding stocks from the Dow Jones Average. And the premise behind this strategy is that we'll look at our dividend yields, and that a stock's dividend yield tends to increase when two things happens. Either the stock has fallen out of favor with investors and the price has not appreciated with the broader market, or that stock has price has fallen because its business cycle is at the end of one of its business cycles, a contraction or of that market. Many times a stock price falls during recessionary periods where that company's revenues or sales contract. A good example of that would be the oil patch. Just last year, a lot of our oil stocks have high yields because their stock prices has fallen. So dividend yields are calculated by dividing the total yearly dividend by the stock price and times it by $100. So, for example, if we have a stock that pays a total yearly dividend of $5 a share, and over a course of a year, and that stock's current price is $100, then the yield would be 5%. If that stock's price went up to, let's say, $200, then the yield would only be 2.5%. And conversely, if the price of that stock fell to, let's say, $50, then that $5 dividend would yield 10%. So part of the dogs of the Dow strategy is, hang on, be patient with me here. Part of the dogs of Dow strategy is look at these dividends and how they relate to these stocks. So I'm in stocks here under our main page, and I'm under the Dow Jones Index. And here are the 30 Dow stocks right down here, right? And, anytime we give you a list and bar chart or categories, watch lists or portfolios to that fact, we do offer some standard views, main views, and some information on each one of these views. So we have technical, we have performance. But if we go into the fundamental view, here we have our Dow 30, and we do see where we can see dividends and our dividend yield. And so if I click on dividend yield now, what it will do is my list will now categorize these in terms of those stocks that have the highest yield. And so if I just count down 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, you'll see that I get down to JP Morgan Chase. And so all the stocks above JP Morgan Chase would be our 10 dogs of the Dow, because they have these high dividend yields. Now, just to give you some reference here, and one of the reasons why the dogs of the Dow theory or strategy works is that if we look at the dividend yield for all 30 of our Dow stocks right now, I did this calculation yesterday, and it's always changing, but right now it's about 2.5%. And so you can see that all of these stocks, including JP Morgan, are above that 2.5%. And some of them are nice, almost double the average of the Dow stocks. But also, to give you other reference here, if you look at the S&P 500, the average dividend yield for the S&P 500 is 1.54%. And if we look at the NASDAQ or the Qs, it's only 0.56%. So you can see that the dogs of the Dow, in terms of dividend value, is a lot greater. And the average dividend value or return yield for our 10 dogs of the Dow, when I did the calculation yesterday, was 3.85%, almost double more than double the S&P, and 6 or 7 times that of the NASDAQ. So what I've done was then I took these 10 or so dogs, for instance, and I created a watch list. And again, there's tutorials in our website that shows you how to create a watch list. Now, those of you who can count very quickly can see that there's more than 10 stocks in here. And the reason why there is because the bottom 3 or 4, when I was starting to put this webinar together, would be jumping back and forth depending on price action. And actually, in the last few days, Merck jumped in to the top 10. It was outside the top 10. So I do have 12 here, but again, it's about JP Morgan and above. But we do see Amgen and Johnson Johnson are just on the cusp of being one of those 10 of the dog Dows. So one of the other things that we can do with our lists is not only on the views that you already get from Barchart, but we can look at some custom views. And so I've made a custom view, which is called the dogs. And we'll come back to this one in a second. Okay. All right. So many of these companies fall into the two categories of what we would call cyclical stocks or defensive stocks. Now, cyclical stocks are more closely tied to economic cycles, and traditionally these are our banks, our energies, our transport, and retail companies. Defensive stocks, these are not defense stocks, not guns and tank stocks. These stocks are those whose revenues and dividends are considered stable or secure. And classically, these would include utilities, healthcare, and consumer staples. All right. And defensive stocks tend to hold values in a broader bearish market because what happens is investors will seek these higher dividend yields, sometimes referred to flight to quality. Johnson & Johnson is typical of that stock. That stock you can watch on days when the Dow has a down day. Typically, Johnson & Johnson goes up because there's this flow of monies into these defensive type stocks. Okay. All right. Let's see if I can figure my animation out here. All right. No worries. So I want to talk to you guys about more market rotation and the concept behind what we see in the market on a month-to-month or year-to-year basis. What we see normally is that certain sectors or groups of stocks will carry the ball, so to speak, and drive the market, broader market higher. When these stocks' price valuations become inflated, investors tend to take profits in these stocks and look for others that have greater opportunities. And some of those valuations that they look at are book value, earnings per share, sales per price, etc. Right? So, so what I've done is I've gone back to our Dow 30, and this is that custom view that I created, the dogs. And I put in here, here's the last price, what industry that stock represents, what sector it's in, and these more common price valuations, price for sales, price book value, PE ratios moving forward. And also here we have the 5-year dividend return, how much dividend has increased over the 5-year period. So one of the things we can do when we look at our dogs or Dow is, is this stock not only a safe and stable stock, but is the dividend safe and stable and continuing to grow? And you can see for a JP Morgan over a 5-year period, that stock has dividend has almost doubled in a 5-year period. So that's kind of a good thing, all right? But let's just categorize these in terms of book value. And here you can see that some of the top 5 that have a very high book value, Home Depot, Apple, Nike, Microsoft, Vista. These are the stocks, these computer technology stocks that have been leading the market over the last 6 months. So their valuations have gotten a little bit lofted, right? And not saying that these stocks are going to go lower or that they're not going to continue to go higher. It's just that their valuations are a little bit more inflated than, for instance, if we look at the bottom of our 30, we do see that many of those dogs of the Dows that were on our watch list, Verizon, Dow, Walgreens, Chevron, they're at the bottom of our list. So that's telling us that in terms of their peers, their stock price is relatively more valued because their book value is cheaper than let's say a Home Depot. The other thing we can look at is sales, right? How are sales? And we talked about this concept of economic cycles, cyclical stocks, and bottom of a business cycle. And again, you can see that the stocks that are at the top of the list are the ones that have done really well in the last 6 to 18 months. Visa, Salesforce, Microsoft, McDonald's, Apple's, those have greater sales. And again, if we look at our bottom third, we do see that a majority of our dogs are in this bottom third: Verizon, Chevron, IBM, Dow, Walgreens. Again, this is just kind of telling us that these companies' sales might be a little bit less than normal economic activity, or that they're just in a cycle where sales have pulled back, and now maybe we can find some greater price appreciation in these if we can find trends that relate to these stocks and we see increase in their sales. All right. So there's this position balancing that investors seek between growth stocks and value stocks, right? And this is based on their appetite for risk, right? The more risk you're willing to take, growth stocks, you might get a greater return. But if you want to take less risk, you'll have to take less return. So, growth stocks are really, their price is rising in anticipation of greater things to come, greater earnings, greater sales, and greater price appreciation. Where value stocks, those stocks are the ones that are more established or steady or consistent, right? But many times a value stock can become a growth stock. About 2 or 3 years ago, Apple was actually considered a value stock based on its book value, based on its sales and the price of its shares. But now you can see, it has been more of a momentum stock, and its valuations have gotten pretty lofty. So some of the leadership sectors that are typically we see are technologies, financials, consumer discretionaries, consumer staples, energies, communications, industrial materials, and healthcare. In the last couple of years, what we've noticed is that there has been 2 or 3 sectors that have been great performers. So let me go to that. Market sectors, and I want to look at what has happened over the last year. And you can see that technology, information, and consumer discretionaries have been the sector that has really been carrying the ball, so to speak. And we can look at the ones that are at the bottom of the list, right? Financials, utilities, real estate, and energy. Energy is definitely one that was pummeled because of COVID. So what we might see is, as we move forward into the next year, 2 years, or 3 years, or maybe even into the next decade, we might see a shift from leadership from stocks that have carried the ball, so to speak, and stocks that will now start to benefit from a new business cycle or a new economic cycle. So just getting you again some references. Back in 2000, the market leaders were energies and materials. Right? In 2010, it was consumer discretionaries and healthcare. The last 3 to 4 years, it's been consumer discretionaries, and IT. All right. So what I wanted to do was show you this scenario and make you understand this is more of a conservative dog of the Dows is more of a conservative a trading idea. So here is our Dow Industrial Average. And I know the chart here is a little flat, but just bear with me for a second. And I'm going to come in here where it says compare. And what I've done is I've typed in two symbols. I'm going to compare the Dow with the SPYG, the S&P growth stocks, and G, I picked green growth, and then I have the SPYV. These are the S&P value stocks, and I picked violet. Right. So let's look at that. And whoops, I forget to change this. We're going to look at this on a percentage scale. This will make it a lot easier to do that analysis. And what we can see here is in the short term, in the last 6 months, actually is that we see the violet line is above the green line. That value stocks in the last 6 months or so, let me see if you can see that scale down here. Since about November, well, maybe 3 months or so, they have been outperforming. And matter of fact, today, you can see that they're outperforming the market, right? So this could be a sign that we're seeing market rotation, right? That these stocks that have been undervalued, investors are starting to buy, and the growth stocks have been the ones that have been carrying the ball, and now they being lagged. But you can see that, in this short period of time from about July or so, they pretty much shadow each other. If we look at what has happened, in the last 3 years, we can definitely see there's a difference here. We do see that growth stocks have way outperformed not only the Dow, but our value stocks. Again, are these stocks price valuations really, really inflated? Certainly they have outperformed the market. Could they continue to outperform the market? For sure. But we can see that our value stocks here, performance is not that of growth. So again, if I'm an investor and I want greater returns and I'm willing to take on greater risk, then growth stocks would be the stocks that I'd be looking for. But if I'm a more conservative investor and I want steady, sure and steady, then value stocks might be the better thing. But you can see that there's a large percentage difference between growth stocks and value stocks in the last 3 years. But if we look at a greater historical, we will see that there is this shift between growth and value. You can see that in the last couple years, this is where those growth stocks have really had taken off, and that our value stocks have been the laggards. But if we go back, 10 or 20 years, you can see that back in the 2000 aughts, the value stocks were outperforming growth stocks. So they go back and forth, right? And so, growth has been the outperformer. But could we start going into a new decade where we will see that value will become more in fashion and growth will give up that leadership, and that what industries, what sectors will benefit as we move to a new economic cycle, all right? So I just want to check my notes here. So what I did was, hang on, let me go back here. What I did was, for fun, I thought what we could do is I created a portfolio of the dogs of the Dow. And this is a hypothetical portfolio. And what I've done is I'm going to do an equal weighted dollar value for each of the stocks. I'm going to purchase $10,000 worth of shares for each of the dogs of the Dow. And what I'm going to do is we'll come back and we'll visit this, sometime in the summer or maybe at the end of the year. And we'll see how this portfolio does compared to the Dow, and maybe how this portfolio does compared to other indexes. What I will do is, as the year goes on, we're going to do a dividend reinvestment strategy. In other words, as these stocks pay out their dividends, I will take that dividend cash and buy more shares of that particular stock, and we'll see how this portfolio works out. Again, laughing to myself, notice that all the dogs of the Dow today are up. The only one that is down is Coca-Cola. But you can see that our portfolio here is only 89,900, and if you count, there are 9 stocks here. So we needed added one more. And what I did say to you is that, in the last week or so, Merck had jumped into the mix. So what I'm going to do is I'm going to add Merck to our dogs of the Dow. And what's nice about this portfolio, as we put this portfolio together, not only can I put in the quantity of the shares and my entry date and the price, but also I can make notes about why I picked the stock.
I think we may have lost John, and this is unfortunately what happens when we are in the middle of a webinar and everybody is working from home, working remotely. And I'm going to see if I can get John back on the line here. If everybody can just hold on one moment, let me see if we can reconnect. I appreciate your patience. Okay, John, are you back with us?
Yes, I'm back. Are you there?
I think so.
Can you hear me?
We can hear you now.
Okay. I apologize for that. Modern technology, right? And it's actually funny because we're going to talk about advancements in technology is one of the ways that we're going to look to invest in the Dow. And so here's definitely.
So really, everybody, thank you for being patient and holding on there. I was trying to get John on his cell phone. And again, this is what happens when everybody is working from home, working with our home environment.
Yeah, the new normal, as we talk about it, right?
Okay,
yeah,
so
exactly.
John, you were entering a portfolio transaction from Merck, and we see on the screen that you calculated a quantity of 123.5 shares.
123.5 shares based on the closing price on the January 4th and a dollar value of $10,000. Okay?
Wonderful. I'm leaving it up to you now to get us clear sailing, okay?
Okay, great. Thanks, Gene. So again, one of the things we could do is we could set a low value. Let's say if stock falls below $75, or I could set a high value. Let's say I want to know if the stock gets above, $90, and then I'll apply that. Oh, don't tell me I got knocked off again.
Nope, you're here, John. You're all good.
Let me see. I might have to reboot.
Yeah, well, you'll have to go back into your portfolio, I think.
Yeah, I think you're right.
Yeah, if you lost internet connection, there you go.
Yeah, let's go back and try to do this one more time. Merck. And we said 123.5. We'll change the date to the 4th. I hope this is not a thing to come, Gene, for this year.
Don't say that, John.
I know. I'm just saying. Okay. All right. Woo! There we go. All right. So Merck is in, and now our portfolio is just around $100,000. Okay, and so we can see that so far this only 3 days into the year, the portfolio is up almost 3%. So that's pretty impressive in just a short period of time. Okay, so let's go back to our slides, and let's talk about some recent trends and some upcoming trends that we can start thinking about. And as we go through these trends, I want you to think about how these relate to the dogs of the Dows that we've just looked at, and which one of them are going to benefit from an increase of one of these trends. Now, when I do trend analysis, and when we have our webinars, we talk about trends in terms of price action. What I'm really talking about here is macro trends. And the way I look at investing is I kind of just look at the world around me. I try to perceive what I see, what is affecting me, how am I consuming goods, how am I relating to the world, or how people that are in my inner circle, things that they're doing, and see if I can recognize. I trust my instincts. I see that, and so the elephant in the room is COVID-19 and related trends, right? And as we move outside of the past COVID situation, and we move to what we consider to be a new normal. So think about those trends that we're going to look at here, and how they relate to this COVID new normal, right? So the first one is the 5G implementation. Those plans had been put on hold last year because of COVID, but I think you'll see a lot more companies will be rolling out this 5th generation, this new cloud technology, this massive data collection technology, right? Verizon, for instance, has, you watch their commercials, they tell you that they're spending billions of dollars on 5G technology. IBM, Cisco, those companies are definitely part of that trend. As we get greater acceptance, right? I look at my circle around me. Most of my friends and my family members still have 4G phones, and so I don't know many folks that have a 5G phone. So I think that will accelerate as we move forward. And adaptations, right? So when we think about some of the trends that are going to come forward in the market, as 5G becomes more accepted and adapted, what adaptation will occur? One of the things that we'll look at, maybe for instance, in the healthcare sector, let's think about 5G and healthcare. Certainly demographically, you look at the population of the United States, and I'm a baby boomer, and I'm at the end of the baby boom. We're getting older, right? And as we get older, we're consuming more health care, right? The old expression that when you get older, it sucks. Well, it does. Your body starts to fall apart, and you go into different, doctors that I never thought I ever had, But so you're seeing that part of our generation, that part of segment of our population that are going to consume more healthcare goods. But let's go back to COVID and 5G, right? Think about, for instance, Walgreens, right? We're going to roll out vaccinations over the next 6 months, right? The government's telling there's 100 million vaccinations that are going to come out, and that for the most general public, you're going to have 2 places where you're going to be able to get those vaccinations, CVS or Walgreens, they're telling us. Well, do you think Walgreens is going to let 50 million people walk into their stores and just get a vaccination and walk out? No, I don't think so. I think they're going to have some kind of strategic plan that they're going to make sure when that person comes in to get that vaccination, that they find some way to get them to consume, Walgreens. But let's think about the 5G aspect of it, right? What if Walgreens offers a app or a technology that allows you to do contract tracing, or an app that's lets you prove that you got the vaccination, right? And maybe we'll have restrictive travel unless you can prove that you are vaccinated. So the combination of these trends might benefit Walgreens. A continued growth in our remote work technology. We laugh about it just a few minutes ago, but this is definitely a major trend that is sweeping across the nation. Folks are working from home. I look at my wife, her company is 1,000 employees over 3 continents, and they're shutting their offices, and they're all working from home. Well, they've also given her an allowance to buy a new computer, new displays, things, and also to upgrade her internet, which we haven't done yet, but also other security measures, right? So let's think about what companies will benefit from that. Again, if we go to our list of dogs of the Dow, right? At Cisco, that one would, networks, right? That would think. But Verizon, right? Verizon, having access to not only 5G, but people are making sure that they have the fastest internet connection in their homes, right? So there is a lot of connections about trends that are coming, and these dogs. More government spending as we have an incoming administration. What policies, what agendas will the Biden administration implement over the next 100 days, over the next 2 or 3 years? Just as a historical perspective, though, there is some aspects of that markets, until they see the agendas roll out or they're confident that administration is going to be able to implement those agendas, that a lot of times when you have a change in administrations, the broader market will contract or go sideways until those plans start to unfold, right? The stock market notoriously doesn't like uncertainty. Now, I don't think there's a lot of uncertainty. I think we know what we're going to get, but will they be able to implement those spending policies? And certainly part of that spending, you talk about green energy, we talk about healthcare. These are part of the platform of the Biden administration. And the final one, I think, that is really important here, and I really believe that this is the one that's really going to motivate the price movement in our dogs, is these diminishing returns in fixed income investments. Again, we talk about a mega trend and population. As investors get older in their investment cycle, investors tend to become a little bit more conservative. They're not willing to take on a lot more risk when we're younger. As we get older, we want to make sure that the monies that we have in our retirement account are there for us when we come to retirement. So traditional fixed income investments over, let's say, the last 20 years, you go back to like the year 2000, and the 30-year bond or the 10-year note was trading somewhere between 6 and 8%. In 2010, that yield had fallen to about 5 to 3%. And now you look at the 30-year bond or the 10-year note, we're under 2 and 1%. But even like corporate bonds and municipal bonds, or even just basic certificates of deposit, CDs, there is very, very little return in terms of investment quality or return on income based on yield in these typical of fixed incomes. So what I believe what you're going to see is that folks like myself who are becoming more conservative in our investments are going to have to seek out alternative investment products that allow us to get greater returns, interest returns. And the dogs of the Dow is based on a dividend, right? So these stocks are very attractive to individuals like myself. I just want to make sure that the stocks that I'm investing in not only are going to give me a good return, but are they safe, right? And certainly a lot of these stocks here, I can kind of consider that they're going to be around. Hopefully, they're going to be around. And maybe some of these stocks will actually appreciate in price. Think about a dollar value in dividends or yield in dividends. For instance, let's just look at, where's my fundamentals? Performance. Let me go back to my stock market over here. If we go back to the Dow and we look at dividends in terms of dollar values, okay? And you can see IBM right at the top of the list, $6.50 yearly dividend, right? And IBM is trading around, today it had a nice breakout, it's trading about $130. Well, what if the dividend stayed the same, but the yield started to fall? In other words, IBM appreciated in price where the yield would start coming in, and the yield fell back into what would be considered normal or uh, more comparative with its peers. Let's say falls back to, let's say, 2.5 or 2.7%, half of what it is now. What would be the value of IBM stock? Well, the IBM stock on a $6 dividend would be closer to $240. Now, I'm not saying that IBM is going to go to $240. I'm just saying based on a dividend yield that is more like what we see in other Dow components, the IBM as a price in terms of yield is very undervalued, right? So one of the things that we can do as investors is, if I'm not interested in, buying IBM, or maybe $130 stock is not something that I want to invest in, right? I can still look for those price appreciations and other trading aspects to allow me to take advantage of it. I believe these trends are about to take place. So let me just show you a kind of cool little strategy that I employ when I'm looking. And I don't necessarily have to do this with the Dow dogs, but this is one of the techniques that I do use. Is let me go to options first. I'll go into unusual options activity. And what I'm trying to do here is I'm going to look at the stocks that I'm interested in, see if there's any unusual activity. So one of the cool things that we can do now with Barchart, and this is a new feature that has been rolled out in the last few months, is I can screen on some of my lists. So I'm going to go to the screener. And again, if you want to learn about this strategy we're going to talk about, we do have a webinar that we've done in the past. And we're going to go into our screener, and I'm going to screen on my list. And I'm going to go to my watch list. These are my dogs. And I want the underlying, not the options. And I'm going to add it. And then I'm going to pick the list that I want to screen. And there's my dogs of the Dow. And I'm going to look in here to see if I see any unusual options activity. Now, what I'm going to do is I'm going to discount a lot of these ones where we have only a few days to expiration. I'm not going to look at those. I'm going to look at ones that are at much greater distance. Now, this morning when I was looking at this, we were just talking about IBM, so I'm going to do IBM, but I do see that has popped up since the webinar started this morning is a Verizon. And what we're going to do is we're going to look for these ones where they have days to expirations, 100 days, 200 days, 300 days, 700 days, some of these elite options. This one is 1 year in the future. And then what we'll do is we'll look at the strikes and the premiums that the individuals are paying and see if we can relate that to our price action of our chart. So let's go back to IBM. Now, this is only 72 days out, but you can see that they were buying $150 calls, and they're paying about $1, right? Looks like about $1 for them. So this institutional investor is saying that in the next 72 days, they believe that IBM is going to get above $1.50, right? So what we can do in options is we can use that as a target, and then we can look at current price and look to see if there's a way where we can appreciate or capture that price movement between now and the next 72 days. So I'm going to go back to IBM, and the strategy we're going to use is called a bull debit spread, or bull call debit spread. Bull call debit, right? And again, we want to look out farther in time, right? So what was 72 days? That's about into March, right? 72 days. And what we're going to look for is we're going to set 150 as our target. And a bull call debit spread has two calls in it. We're going to buy a cheaper call, a call that is closer to current price, and we're going to set a target of a call of a higher price. So we're going to set the target of 150, and I need to find a strike that's below 150 in terms of price. So what I might do is go back to my chart, and let me just change this chart to IBM so we can do a little price analysis before we decide what strikes we're going to use. I'm going to use a little bit more historical value. And here you can see I drew a line at 135. It looks like if the IBM gets above 135, $1.35, then that $150 strike, that institutional trader who's predicting that they're buying that option, that price is going to get to 150 in the next 72 days. There is a lot of room for price to run if it gets above 135. So I'm go back to our options chain here, and I'm going to look for the 135 150 strike combination. And let's see, here we go, 135. That's my first leg, and there's my target, 150, right? And let's see what the result is. Well, it's going to cost me $3.19 per share, but if IBM does get to $1.50 in the next 72 days, I'm going to make $11.81, or a return of 370%. That's about 3.7 to 1. That's a nice return on a stock that I just found based on an unusual options activity, but not only on an unusual options activity, but this is a stock that I believe is going to appreciate anyways because of this rich dividend yield, and this company's now going to benefit from a greater business cycle or a new set of trends that are going to outplay over the next 3 months, 6 months, 2 years, 5 years, maybe as far out as the next decade. The only caveat about doing this option play is we don't get the benefit of having the dividend in our portfolio. We're just playing on the pure price movement. Okay, so I see a couple questions here. So I definitely want to look at those questions. Gina, are there any questions that are popping out about individuals that are asking about some of the things that we just talked about?
I forwarded a few of them to you earlier. You should have those in your inbox there.
I see them. I'm reading them right now. Okay, so David asks, when we see action occur in a certain sector, we know we are unable to time the turnaround. Yeah, that's right, David. A lot of times, what we want to do is we'll wait for that. We might miss a little bit of that trend. But again, this strategy is not about getting rich quick or trying to jump on, picking a turnaround, right? We want to see that trend starting to develop, and we want to find trends, greater trends, mega trends that have a lot more legs. So again, David, it's not about timing here. It's really about picking those mega trends that we think that are going to have legs, longer periods of time. But certainly inside of Barchart, we do have a lot of opportunities, either through looking at the sectors. Again, if I go back to my stock and sectors, right, we can look at what sectors are improving today. We can look at the last 5 days, last 3 months, 6 months, year to date, 5 years, 10 years. So there's a lot of ways to look at momentum in shorter periods of times. What we kind of want to see is, short-term momentum that is also starting to play out in a little bit longer play out time. Tom asks, when looking at dividend stocks, also consider payout ratios, the ability to cover the dividend and debt load, how much credit they're carrying. Yeah, that's definitely, Tom, that would be definitely somebody who is a little bit more sophisticated as a trader. And there is that caveat that some of the stocks that, some of the stocks that have high dividend yields, those industries or those stocks might be having bad business cycles, and they might cut their dividends if they're cash starved or they're trying to protect themselves. But what I think you see in the dogs, the Dows, we have blue chip stocks here. I feel that those dividends are safe, and a lot of these stocks, the CEOs of these companies, they want to make sure that they have consecutive dividend payouts. That's a very attractive scenario for mutual funds and ETFs. They like to see that, so they're more willing to invest in those stocks. And the other thing is, if they do cut dividends or they stop paying dividends, then that would take those stocks out of some of these ETFs or expunge them from them, right? So they're not allowed to use that stock anymore. And that would actually be a bad scenario for their stock price. So, again, if we're talking about, a new company or something, or a company whose industry is being phased out, then yeah, I might be worried. But I'm looking at these 10 blue chippers. I feel pretty confident that these stocks are going to be around in 10 years' time, and that their dividends, especially those that we saw when we looked at our list, those are the ones that have not only been paying out for 5 years, but are seeing an increase in their dividends. Okay. So Mary asks, what strike for IBM for selling calls? So we looked at the purchasing the 135 call and selling the 150 call based on the chart price action where we think where IBM could go. But if you look at, we looked at Verizon, and I think they were right around 45. I think I saw strikes. So let's look at Verizon down here in terms of price. We can do a Verizon analysis since we're doing here. Yes, Verizon is trading $59. All right. So let's go back to our unusual options. And this one's going to be a little bit more intricate in terms of how we look at the strike prices that we're going to play out here. Because I think what I saw when I was doing this, when we ran through this last time, was that they were buying some very in-the-money calls. And that's a strategy a lot of the guys will do, is because what it does is there's a lot of intrinsic value, and this is a way for them to set a more sensitive stop to the market. So let's go to my list. Watch list. Underliers, add. There's my dogs. How are we doing on time, Gene? We're getting close, right?
We're getting close, yeah.
Okay. So let's see. All right. So yeah. So what this investor has done is they've bought $40 and $45 calls. Now remember, the current price was $59, but they're buying a call that's not going to expire for another year. But they're paying, $15, $20, right? So again, we can look at that as an entry level, right? And in other words, we're going to look at $60 or above, right? Well, that's right. These guys aren't in it to break even. They're in it to make money. And what this investor is saying, hey, I'm paying $15 for a strike, and I want to see Verizon get $60, right? And wow, you can see that, yeah, above $60, $62, right? Verizon looks like is going to break out. Now, this is over a 3-year period. Let's look at a 5-year period, right? This would be new territory for Verizon. Now, again, we go back and look at our dividend on that Verizon, and we'll look at the yield on that. And if we did a comparative analysis in terms of its peers, maybe we would discover that Verizon, based on a 2% yield or a 2.5% yield, might be worth $80 or $100, right? So we could look at setting a bull call strategy where we're going to buy $60 calls and sell a $80 strike, right? And try to capture $20. But I'm not going to do a short-term trade. I'm going to look at ones that are 6 months or a year into the future. Okay. So Nora, I hope that helps you how we decide how. Nora asks, how do you pick the option prices? Again, it's a combination of the strikes that are being bought in the unusual options activity and a price analysis as we look at our chart, right? Where do we see where price has been and where do we think price is going? Deb asks, you mentioned Dow ETF. Yeah, there are some investment strategies. There are individuals and ETFs that do look at Dow. There's also, high dividend yield ETFs. So, and a lot of the dogs of the Dow will be in those ETFs. So there are ETFs that are related to that. Okay, so just to wrap up, again, this is a more conservative strategy. It's part of a larger portfolio as an investor. I don't want to put all my monies into one sector or one stock or one value versus growth, and it's a way for diversification. Looking forward, right, what of our dogs in the Dow stocks do we believe could benefit from some of the mega trends that are starting to unfold in the market? And it's kind of weird that we're doing this segment this week, and boy, you look at 2 or 3 of the ones that we mentioned that are going to benefit from some of these new trends that are going to unfold over the next 6 months to a year. And these are the ones that are moving today, right? IBM, Walgreens. I think Walgreens had a news story that came out today. It was about they're shedding a part of one of their the companies. Verizon announcing a rollout of some new technologies. The energy market, right, starting to come back. We're coming back to a normal, right? We're starting to see economic activity starting to pick up. So I hope this was informative for you guys. And always I want to remind you that all our sessions are recorded. So you can come back and watch this again under our free webinars.
Hey, John, tell us about your next webinar.
Oh, thanks, Jean.
Coming up next week.
Our next webinar next week, we're going to look at how to use futures markets to look for trading opportunities in ETFs. A lot of folks don't like futures markets, or they don't understand futures markets, or they fear futures markets because they think they're too risky, and I understand that. But there's a lot of information in terms of markets and trends that we can gain from looking at futures markets and how they correlate or relate to ETFs. Not only the physical ETFs, in other words, a gold stock ETF, but also we'll look at parts of the economy that are affected by these commodities or these futures markets, and what ETFs or what industries or what sectors could benefit from price action. And I think that one will be an interesting one for those who want to become a more rounded investor. Learn how to look for trading ideas outside of just looking at ETFs themselves. Okay. But I just did want to point out here under our webinars that we do have a webinar that was talking about, here it is, how to trade bull call debit spreads. And that is that scenario that I just played out for you guys, if you want to go back and watch that. Any other questions? I don't see anything popping up. Am I missing anything, Jean?
That's about it. Just a few people asking about a recording of the webinar. You will get an email a little bit later on this afternoon once that's available. So just watch your inbox for that, or you can come back to the webinar archive page that John is already showing you, and there's a link very bottom right hand. There's a link out there already, but the video is not there. It won't be there until later on. So you can always come back to the archive page and view the information there. And then finally,
also remind everybody that there is opportunity to, some of the screeners that we've looked at today will be part of a premium package, and there's a way to come in here and try out our premium platform and a lot of the tools and pages that are available to premium membership for 30 days. I would definitely recommend trying it out. Take that car out for a test drive, so to speak, right?
That's right.
Well, I want to wish everybody happy New Year, and many good returns and health in the new year, and the best of all trading.
Thank you again, and thank you for being a Barchart member. See you next week.